Oh, hi everyone, I hope you're all well. One of my clients got me, one of my subscribers got me thinking about what would happen if the equity market sold off big time like we saw in 2008, and how would XRP help in that situation with fiat markets collapsing, and also just the comments, obviously out of the World Bank and the International Monetary Fund. So it actually got me thinking, and I thought I'd just put something together. It is a fairly long-winded video, so please bear with me. It's just to build a background to basically how Ripple's technology and XRP can help in that sort of situation. But I just want to go through some economics and some curves and FX and all that sort of business before. It's just building a picture to explain this. So just bear with me. So if we look at just the equity market, we've seen this situation where we've had massive bulls and we've had bears, and the bull market tends to last longer than the bear market, as you can see by this from First Trust, if this is correct. And generally the average, it looks like, for a bull market is about 9 years or so. And I guess the thing is, we're getting very much near that now, the end of a bull market. It looks like it's done its dust with the Dow well over 2600 or so. And I'm just wondering, are we getting to lofty levels on the US stock market where basically a correction, is coming, and like a major correction? And what would the catalyst for that be with a major correction, and how XRP and Ripple's technology would help in that situation? Plus also look at the other markets like foreign exchange market, essentially the interest rate market, credit markets, and so forth. So it just builds up a picture to give you an idea of where we're at the moment. So clearly, with the US Dow stock market, we're at very, very extreme lofty levels. And certainly from 2008, we were down here around sort of 5,800. And now we're way up here, which is over 2,600. So 26,000, I should say. So as you can see, certainly the quantitative easing by the Fed put lots of money into the system, and it created a situation with yield curves being negative, and clearly any risk assets have been going higher and higher. And you've got to question yourself, when is this party going to stop? I just wonder when it is going to stop, because this is almost like parabolic straight up, and eventually there's got to be some sort of respite for this market to come down, I should imagine. So this is just food for thought, actually. It's not investment advice or anything like that, but it is just food for thought. So certainly in the time when we had the 2008 scenario, gold, as you can see, went up, and went up from low levels. And we saw that again in 2001, way back here, it was about $200 US, and then it went up to this level here around 675. And it's been going up, and then it's sort of consolidating around this level, still above the 200-day moving average. Now, generally when we do see market meltdowns, we see other commodities go down, but gold tends to go up, and it tends to be a hedge against other fiat markets, and that's generally the case. Now, what we do also find is when fiat markets go down, there's a massive move out of risk assets, and there also is a massive move out of what's potentially viewed as a risk foreign exchange currency, for example. So what we find the traders doing, or the investment fund managers, is going to yen, going to the Scandinavian currencies, whether it be the Swedish krona or the Norwegian krona, and also buying the Swissy. So also we do find in times of market implosion that cash is king as well. So we do see the scenario like you saw in 2008. The market went to the Scandinavian currencies as well as the Swiss franc as well. Also, we do find when markets implode, we tend to find that interest rates tend to go down of the AAA rated countries in the world, or the high credit rated countries, not so much the emerging market countries in the world. Interest rates tend to go up in that scenario when markets are falling down big time. So we found that in 2008, the bond yield came down to 2% from 4.8%, and now we're in a position where bond yields are starting to move up again. Still under the 200-day moving average, but they are starting to move up again. This is a 10-year bond yield. So if we look at the Italian bond yield, and the reason why I look at the Italian bond yield is because Italy, to me, is starting to resemble Greece. They've got a lot of problems. They can't pay back their debt. They're being jawboned by the European Central Bank to pay back their debt. And if they default on some of their debt repayments, they're going to start to resemble very much a Greece scenario. Plus, they've been told to have some sort of fiscal responsibility, and the Italians have just ignored the European Central Bank. So they're starting to look like, in my mind, a bit of an emerging market country. And effectively, if that's the case, their yields should start displaying like an emerging market country where their yields will actually rise. And we have seen this too, notwithstanding we've seen yields rise everywhere, but Italian bond rates are the thing to look at, because if they don't pay back their debt or they default on their debt, these yields will rise sky high because investors will expect more return for the risk they're actually taking. So if we go to South African yields, again, it's considered an emerging market yield. And certainly when markets went down in 2008, they were considered a risk spread. So when markets come down, the traders and the investment managers go to risk off trades. And we did see that with the South African yields. Yields went up, and then after that it came down. But now we're starting to see yields rise again. And emerging market debt spreads globally are starting to go up, which is not great for equity markets. If emerging market debt spreads rise, it means that they're starting to price in more risk as time goes on. So if we go to Turkish 10-year bond rate, we know what's happened in Turkey. Their economy looks terrible. Their economic numbers are getting worse and worse. The Turkish lira has literally fallen out of bed. It's devaluing dramatically. And you'll see that yields are actually rising and rising quite quickly from their low levels. And that's simply because international money managers and central banks of the world that are AAA or better rated than the Turkish central bank don't want to lend them money. And when that becomes the case, they have to raise their yields to try and get money into the system. But the problem is, coupled with that, they've got a Turkish lira which keeps depreciating. So me as a bond manager, I don't want to buy Turkish bonds, even though I get a rate of 19 or 20%, because I'm losing on the currency. Once I buy Turkish bonds, I'm actually long Turkish lira. I bought Turkish lira and I've sold out of maybe the US dollars or something like that. Now, another problem is international fund managers cannot get out of the Turkish lira, and they can't get out of Turkish bonds at the moment. So the Turkish government has told the Turkish bond traders and the money market dealers on the Turkish desks that they don't make any markets to the international bond traders. Now that means basically they cannot get out of their Turkish bonds or their Turkish lira. So if the Turkish bond keeps going up higher in yield, they're going to continue to lose money, because as yields rise, prices go down in terms of bond land. And also, if the Turkish lira keeps depreciating, they're losing more by holding Turkish lira because it keeps going long. Effectively, if they hold a Turkish bond, they're actually long, or they're bought Turkish lira. So if the currency keeps going down, they're actually losing more money as we speak. So they're losing it on the bond yield, and they're also losing it on the Turkish lira going down, which is not a great story for an investment manager that can't get out of his position, and he wouldn't be very happy about that, that's for sure. So basically, the Turkish government has literally, how can I say this, has literally really closed the door for international investors going forward, because again, if you can't get out of your positions as an international bond investor, now I used to be an international bond investor, you're never going to go back to that country to buy bonds, which means you're not going to fund, their central bank or their capital position or anything. If I buy a bond, I give them my cash. And if I can't get out of my position, my Turkish bond position, I will not go back to that country to fund their Turkish bond program, okay? So what we also see here, if we look at the Turkish against the US, it's just gone down, 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 down. Now, if I'm a US bond trader or an international bond trader, I'd rather be in the US, because the US is actually appreciating against the Turkish lira that keeps going down, down, down. And I'm losing a lot of money by being long Turkish lira. as it keeps going down. And that's a terrible, terrible story. So if you look at the Turkish inflation rate, now this fellow here says that the real rate is something like 43%. The government reported rate is 20%. So again, it basically means if you're holding Turkish lira, it's losing money all the time. The purchasing value of your dollar or Turkish lira is going lower and lower and lower. And it's a terrible situation, basically, particularly if they have foreign debt, because their lira is lower and they've got to pay back much more for their foreign debt, okay? So your purchasing power is seriously eroded. Now, Turkey's a very large country, 80 million populace, and this is not a great story for the populace because it basically makes every person, the average saver, makes their savings worthless. And that's pretty much like what we saw in Germany pre-1933, a situation of hyperinflation where they've got this 43%. And the currency was basically worthless. You could literally, use it to keep yourself warm. And this is pretty much what we're seeing in Turkey at the moment. So if we go to other emerging market foreign currencies, we also see the same story. India. The US is appreciating, going up against the Indonesian Rupiah, which is going down, okay? And that's been a long-term story. US is going straight up. This is US to India Rupiah, I should say. And that's not great for India. And India has a population of 1.339 billion, which is a very large population. If we go to Indonesia, which is near Australia, US against Indonesian Rupiah, we've got the same story, an upward trend. US dollar is appreciating, the Rupiah is going down. And again, Indonesia is a very large country near Australia of 264 million people. Put that in perspective, Australia is only 24.5 million people. So Indonesia is a very, very large country, but their rupiah has been depreciating over time against the US dollar, which means their savings are actually going down the gurgler, getting less and less. So if we go to high yield bonds, and again, these are credit spreads in times of implosion start underperforming. Now, if we go back to 2008, we saw high yield bonds underperform by 26%, like the stock market, which was down overall 37%. And in times of risk, like the Asian crisis in 1990, and I remember working then, high yields were down again, 8% and the stock market was down 3%. So these things tend to have almost like a positive correlation to the stock market generally, but also it gives you an idea of what credit spreads are doing, funding costs of corporates, particularly corporates that aren't rated. These are high yield corporates that would be funding, so they're not rated. But also what you should look at is swap rates, because that's the funding curve for the banks, but also corporates will fund over and above the swap rate. Now in 2008, leading up to 2008, I noticed swap spreads were really blowing up, and I was very nervous about the equity market. To me, that was a precursor for the equity market coming down. Now, this is only up until 2015, but I have had a look at swap spreads. They're at their all-time lows, and I think there's a real risk that swap spreads start moving up, which is the cost of funding for the banks, but also cost of funding for corporates with the spread on top. And that's basically the debt side of the balance sheet. So again, if swap spreads and the cost of funding for corporates going up, you've got to be concerned about where the equity market is at the moment, because the equity market looks very, very expensive from an investor's point of view and very, very cheap for an issuer's point of view, okay? And if it's cheaper to issue equities than it is to actually issue debt, then most corporates are going to issue more equities, okay? But you can't have the two a complete mismatch, where it's only costing you, say, 2% to issue equity, but it's costing you 6% to equal corporate paper. Something's not right here. Either the corporate bond market is too cheap, the equity market's too expensive, or vice versa. Either the corporate bond market is too cheap and the equity market's too expensive, or vice versa. So if we look at, and this is just a little background information, if we look at the US debt clock, you'll see this, and the US debt is just rising by the second, and we're talking trillions here. I think that's 22 trillion. There's so many figures I don't even know. And that is getting worse and worse and worse. If you look at this, it'll tell you where that debt's sitting, but ultimately that debt is being funded by Japan and China, okay, through US bonds and US treasuries. So the national debt is going higher and higher from 2005. It's gone all the way up here and building, and basically 99% of the US deficit, if you want to call it that, their budget is spent on war weapons. So it's not going back into the economy to grow the US economy as such. It's going to a very specific part of the US economy. If we look at this, who funds the US debt or the credit card of the US? It's China and it's Japan. I'm surprised to see Brazil there, but we've got the others there. Now, the thing is with China, if China stops funding the US credit card because there's trade wars or because China's growth is below 8%, which it is, there's potential that China could redeem their US bonds. In other words, sell them back and get cash and take it back home, and that would be a real problem for the US. And this is where I think, if you're doing trade wars with China, you have to be very careful about how many trade wars you do, because China basically fund the US credit card. Okay, so the US lives over and beyond the means, and China funds 1.18 trillion of that, which is a lot. If you go, and this is all leading into what I'm going to be talking about. If you go to world gross domestic product, and gross domestic product is basically just what a country produces in final goods and services. So in other words, what income they get in for their goods, whether it be income from the domestic populace or whether it be from the external populace. And basically it's a measure of how well a country is doing, okay, in terms of growth. Because if you're making goods and services and you're producing, you're actually employing people. If you're employing people, they're getting money. If they're getting money, they're going to spend money, in terms of consumer wear, that sort of thing, okay? So China in its boom day, it was looking at GDP of 14 to 16%, 18%, and now China is under 6% at 5.8%. Which is not great for China. China, to get its people out of poverty and to go to middle class, needs a GDP growth rate of about 8.5%. So pretty much with China's growth rate down at 5.8%, it's not great. It doesn't get their poor people out of poverty into middle class, which basically restricts, obviously, their consumer products, their consumption, what's circulating around in terms of China, money, services and goods and this sort of thing. So it's not great for the population per se, and the population is big, 1.86 billion. Also, if we look at India, their GDP is going lower. And again, we're talking, a population of 1.3 billion. Indonesia's GDP is at 5%. Europe's a basket case, 1.4% GDP. It's halved in the last 5 or 10 years. We know about Italy, if it can't pay its debts, it's going to be all hell to break loose. We know that South America is pretty bad in parts. Argentina's broke, Venezuela's broke. And even Brazil's not doing very well. We know in Africa, in parts of Africa, things are not very good as well. And also, obviously, we've got the UK Brexit, which is God knows what's going to happen there either. So globally, the world, in my mind, doesn't look that good. The only one that's sort of holding up, obviously, is the US, but there are mixed economics signals in terms of their economic data that's been coming out. And to justify a stock market that keeps going higher, I think it's, to me, this is only my opinion, it's shaky, and I'd be very worried about being long stocks at these lofty levels. And this is just painting a picture, okay? And then we'll get to the crunch of this with Ripple and XRP, because we're building this environment of what's going on. And, given that fiat markets could potentially fall, and we're starting to see it in emerging market foreign currencies and credit spreads and the like, again, with all that happening, we're probably going to see pressure on the equity market going forward. That's my take on this. So, again, China's GDP growth was up here, over 14%, went down in 08, and now it's coming down to these, I've got 5.8 as the next level basically on that. So not great, not a great story. So what do we think? What do I think some of the catalysts for a bear market in the stock market? Worsening economic conditions globally, and it seems to be the case. It seems to me to be the case, definitely. Spread products are very tight at the moment, but they are starting to blow out, and this could lead to more bankruptcies. And to me, spread product is very tight, whether we talk about swap spreads or credit spreads or whatever. And to me, they have nowhere to go but up. Emerging markets sell off in currency. We're starting to see that, particularly with the Turkish lira, and we've seen it with the Venezuelan dollar or whatever it was called. We've seen it with Zimbabwe and all sorts of different African currencies as well. But there's heightened risk in the equity market. In other words, returns are not there for the risk, given that the market's come from 5,800 and now we're looking at well over 2,600 or so. Plus, the Fed has said that they're turning off the taps for quantitative easing, and they want to sell down their bloated balance sheet of 4 trillion. So again, that's going to take money out of the system. China could start redeeming its US treasuries or bonds because its GDP is well below 8%. They don't have the savings capacity they had before, and they could start redeeming some of those US treasuries, which means the US basically is not funding its credit card. Italy, Spain and Portugal may not be able to pay back their debt, and there could basically be a debt fault. And if that was the case, that's going to start to blow out credit spreads dramatically. And also there could be world conflict. Generally, you need some sort of catalyst to move the stock market down. And it could be a number one of these that bring that down. And again, yields are starting to rise, and we've seen that. And if they start to rise even more quickly, that's certainly going to bring down the stock market. And also with that, just adjacent to that, can a central bank go broke? And the reality is a central bank can go broke. We saw quantitative easing with the Federal Reserve in 2008. They increased their money supply and they bought liquid assets. But the way they did that to increase their money supply is they issued US treasuries and US bonds. And when you do that, you need someone that's going to buy that paper to actually put liquidity back in the market. Now, in 2008, we saw Iceland central bank become insolvent. We've seen this with Venezuela. Their central bank has gone broke. And another thing, if a bank issues paper, but their currency keeps falling, the foreign investor is not going to want to buy that bond or that paper. And we're seeing the same situation in Turkey. If the currency keeps falling, no one's going to buy Turkish bonds, because as soon as you buy Turkish bonds, you long the Turkish lira and you start losing money, okay? So the thing is, as long as the central bank doesn't have significant foreign exchange denominated liabilities, it should ensure their solvency. But the thing is, if they have a lot of foreign exchange denominated liabilities like we saw with Iceland, then there is a real problem. And so it's not out of the question that a central bank could go broke. Not that I'm saying the Fed could go broke, but look, again, you have to wonder about their capacity to fund another major crisis like we saw in 2008. Because I suspect if we get another major crisis like 2008, the stock market is a lot higher than what it was in 2008. In 2008, the Dow was around 14,400, and now we're seeing it well over 26,000. So I just wonder their capacity to be able to sustain another major fall in equity markets. It's going to be very interesting going forward. So the question is, given this environment and given the background that I've built for you, how can Ripple and XRP help? And how can Ripple and XRP be used in this environment? Okay, so where are we going with this? So basically, when we see markets implode, we find that all fiat markets are joined by cash, and cash becomes king. Okay, some of the large countries in terms of population are all doing very, very badly. Okay, so we've got them, the red flags there, if you want to call it that. So some of the world largest populations are not doing very well. And this is probably at least, if you add it up, 4 to 5 billion out of 7.1 billion. We even had the IMF chief come out, the International Monetary Fund, BIS manager, general manager, or Augustin Carsten, basically say the International Monetary Fund does not have sufficient lending capacity to respond if a major new emerging market crisis affecting several countries erupted, the head of the Bank for International Settlements said on Thursday. Now, I think that is a real risk because we're starting to see it through the currency market. There's no doubt about it. He said, this leaves us with the problem of having inadequate resources and having to improvise in a time of crisis. The mission of the fund is there, Carstens told a conference of the French Central Bank. If the fund cannot do it, others will have to do it. Otherwise, the economic costs will be huge, he added. Now, that is a concern in itself. Also, given that, we also had Marco Nicolai from the World Bank also saying the SWIFT system is geriatric, it's slow. If anything, in times of market implosions, SWIFT makes it worse because cash doesn't settle instantly, and that what should be used is distributed ledger technology like Ripple and XRP. Now, I agree with that absolutely. Okay, so again, Marco Nicoli has basically said that the SWIFT system is slow and opaque. It is a legacy system from 1973. It should not be used for cash settlement because it takes, on a good day, 2 days. On a bad day, it could take 10. And in some ways, there's argument to say that the SWIFT system could make it even worse for financial markets. So in other words, if the equity market's going down and you've got a margin lend against your equities, you can't get in any money against your margin loan against your equities for 2 or 3 days, and that's because of the SWIFT system, which means you get cut out of your position, your long position of equities, when the market keeps going down. And because they're selling you at the bottom, it actually forces the market down lower and lower, which is not a great story. So when the market comes down, cash is king. There is no doubt about that. And SWIFT can take at least 2 days to get your money, and that's the problem. And it can push the market down further because you can't get your money. At the best of days, bond settlements are trade today plus two settlement days. Stocks the same, trade today plus 2 settlement days, and FX is the same, unless it's an exotic where the settlement day is longer. So you see where I'm going with this. Where does Ripple come in XRP? Ripple has the technology that can instantly settle anything cash flow within 3 seconds. If I wanted to sell XRP, I had a position in XRP, I could go to cash within 3 seconds. Using Ripple's technology, I could literally get out of a currency like a Turkish lira that's going down and go into a currency that's considered safe haven, like the Japanese yen, or like the Swiss franc, or like the Swedish krona, or like the Norwegian krona. You see my drift? You get my drift? So let's put it this way. If we look at the system of XRP, I don't even need to go through the SWIFT system to reduce my exposure to the fiat markets. I can go through Ripple and XRP and the cryptocurrency markets to reduce my exposure and create liquidity for myself. And that is the key. That is the key of Ripple and XRP's technology. And that's why Marco from the World Bank is saying distributed ledger technology of Ripple is second to none, because anyone can reduce their exposure within 3 seconds and reduce their loss. Okay, and to give an example of this, some cases. If I live in Turkey, right, I'm Turkish and I hold the Turkish lira, it's in my savings account, and fiat markets are going down and the lira keeps selling down, which it is, and I'm losing my wealth, I'm losing my deposit. It's not worth anything with Turkish inflation rates of 43%, and the Turkish lira keeps going down, down, down. If I try to go overseas or do anything, it's not worth anything. Plus the costs of goods in Turkey keep rising. So what I can do, given that I have access to the cryptocurrency market, or even if I was a corporate and I have access to Ripple's system, I can buy XRP and sell my Turkish lira. without government control. The government is stopping fund managers from getting out of Turkish lira because it's telling the banks in Turkey not to make markets for the fund managers on Turkish bonds or Turkish lira. Thus, the international fund managers cannot get out of their Turkish lira. But me, as an individual in Turkey, I can buy XRP and I can sell the Turkish lira within 3 seconds. All of a sudden, I'm immune from the downcline in the Turkish lira and I've stopped losing money. If I don't want to stay in XRP because I'm concerned that it might go down and there's more volatility coming, I can always sell my XRP and buy Japanese yen, which is considered a safe haven currency when fiat markets are imploding and going down the gurgler. Okay? So literally, I've exchanged my Turkish lira, which is a basket case currency, and now I'm sitting in one of the safe haven currencies being Japanese yen or Swiss krona or Norwegian krona, whatever it might be. So basically, if I did nothing, I would keep losing wealth and my deposit would become valueless. Now, because of cryptocurrency markets and XRP, I can switch out of Turkish lira and sit in XRP, which will go up, or alternatively, I can switch out of Turkish lira and go into the yen. And all of a sudden, I've stopped myself from bleeding and my deposit becoming nothing. Another example of this, I'm a central bank or a fund manager. Me as a fund manager, I bought Turkish bonds when the interest rate last year was, say, 16%. And as a fund manager, I thought that was a really good level given that interest rates everywhere else were 2%. But the problem is today, the Turkish government has told the Turkish banks, not to make me a market in Turkish bonds, which means I cannot get out of Turkish bonds. So not only am I exposed to interest rates going higher on a Turkish bond, as interest rates go higher on a bond, the price goes down. I'm also exposed because I'm long the Turkish lira. By me holding Turkish bonds, I'm actually long the Turkish lira. So I'm actually losing money as the Turkish lira goes down, and I keep losing money as the Turkish bond yield keeps going higher. So I'm losing money, two aspects here. The Turkish lira keeps going down and I'm effectively long the Turkish lira with my Turkish bond, and I'm losing money as the Turkish bond rate goes higher because as interest rates rise on a bond, the price of that bond goes down. But what I can do, rather than being stopped by the government or by the banks because they won't show me a market, I can use Ripple's technology or the cryptocurrency market, or I can, go to XRP. So I can use my Turkish cash, not from my bond holding, unless I can use this as collateral to buy XRP, which I don't know whether I can. But I can use my Turkish cash to buy XRP and to sell Turkish equivalent a bit more to cover the decline in the currency and the increase in the bond rate. So say I hold a Turkish bond of 10 mil, I can buy an XRP position of say 15 mil, a bit more to cover the decline in the currency and the increase in the interest rate, and sell Turkish lira of 15 mil to offset both the rising risk of the yield and the plummeting lira. So all of a sudden I've sold my Turkish lira and I'm in XRP. And, I can decide to stay in XRP because I think it's going to do better than the Turkish lira, or I can basically sell my XRP and buy Japanese yen for my Turkish bond position. So with my Turkish bond position, I've actually changed it to a yen exposure. So I'm actually long the Japanese yen rather than being long the Turkish lira. So again, I've gone into safe haven foreign exchange rather than being an emerging market debt foreign exchange. And I've basically hedged my risk to offset the Turkish risk by going into the Japanese yen. Anyway, guys, I hope this is all food for thought. Have a think about it. Would be interested in people's comments. Looks like I got a spell error there. Interested in people's comments, but this is only my personal view, but I do think at these lofty levels of the equity market, there's got to be a risk here eventually. Anyway, it's my own personal view. It's not financial advice. I hope you get something out of this. Thank you, Susie. Bye-bye.